Today, eForex chats to James Alexander, Chief Commercial Officer at Invast Global. James, welcome and thank you for coming on the eForex podcast today.
Thank you very much for having me, Larry. It's a pleasure.
James, before we get into the main bulk of the questions about FXPB, tell us about Invast and who you are, where you've come from, and the vision for the future.
Absolutely. Thanks, Larry. Look, Invast is a non-bank provider of prime services down here, based in Sydney, Australia. We've been in operation for nearly 10 years now, but our parent company, who is actually a listed entity in Tokyo, has a lineage that extends back to the 1960s. We specialise in multi-asset prime services, but really have a focus on FXPB, along with other asset classes, of course. And the ultimate goal for the future is to continue to expand our footprint globally, not just with offices in Tokyo, Sydney and Europe as we presently have, but expanding that footprint further and reaching an ever diversified and more diversified audience, predominantly focused on hedge funds and interdealer brokers.
Excellent. So you're primarily in the B2B space rather than obviously the B2C space, right?
Correct. Yeah, we've got a real focus on the institutional and wholesale side of the business. So our customers generally include these hedge funds, quantitative trading funds, and other brokerages themselves, many of whom are interdealer brokers or retail-facing brokers. So we definitely try and really focus on the wholesale and institutional channels.
Excellent, James. I'll go to the main questions. There's been some changes over the previous years in the FXPB landscape and the PB landscape in general, with the recent announcements regarding certain names either exiting or scaling back their engagement in the prime brokerage space, especially in FX, as I say. Has that been a surprise to you?
Yes and no, Larry. I think that many in the industry have felt that, particularly with FXPB, these are businesses that do require significant scale. And significant scale really comes from a broad and diversified customer base and, a strong balance sheet and the ability to service that broad and diversified base. For those in the industry who haven't necessarily got that scale of the customer base or the scale in their business models, it really is quite a challenging time because those regulatory headwinds that increasingly are biting down on those tier 1 PBs are adding additional costs, they're curtailing client onboardings, and really just adding red tape to business models. So in that regard, while some of the names that we have seen either exit or scale back have been a bit of a surprise, the broader trend is one that I guess we here have been suspecting will play out for quite some time and really plays into our core strategic sort of focus, which is that a non-bank prime broker really is well positioned at the moment, given the regulatory landscape and the evolving needs of clients, to really grow and scale our business.
Excellent. And tell us, what does this mean more broadly for the prime brokerage industry on a global scale?
Well, I think some of the exits we've seen will have a ripple effect, some more than others. And I do think that those exits or scale backs really continue to play into the existing themes that we've seen. Those continued tightening of risk conditions and re-rating of commercial terms that really we've seen play out over the last 12 months, and which I guess predominantly started with the fallout from the Archegos capital management debacle, I think is probably the most appropriate way to describe it. That incident has really rippled through the PB industry, and I think a number of the tier 1 bank PBs in particular are really assessing the way they onboard, the way they offer credit, and the questions and the due diligence they perform with their customers with respect to other facilities. Because one of the key things that was really scrutinised post the collapse of Archegos was the fact that any entity, whether they be a hedge fund, a quantitative trading fund, or indeed an interdealer broker, may have multiple facilities out to the street, and it's really been that component of credit allocation that has been most heavily scrutinised. I think the other impact that is sort of being observed, and we certainly see this and hear this sort of through the conversations we have with customers and indeed our own PBs, is that the onboarding queue for new clients trying to access PB facilities has never been longer or slower. I think that the additional due diligence that's being performed is slowing that process. And whenever you have one or many PBs looking to exit or off-board clients, it naturally causes a bit of a bottleneck at those PBs that do continue to onboard and that have the appetite to do so. So the onboarding queue's gotten a little longer. It's a little slower to move forward. And I think ultimately that re-rating of risk and commercial conditions that we've seen is starting to have an impact. And I think clients are really questioning whether they're getting the value from that PB engagement that they want or they expect. For many, the answer will be yes, but for others, particularly those sort of smaller to medium-sized hedge funds, interdealer brokers, who may find themselves, I guess, at the lower end of that PB's customer tier, that's a very valid question, that whole, am I getting the value from this engagement right now? And I think, again, for us strategically at Invast Global, that really plays into where we want to step forward and expand that footprint, as I mentioned.
Right. As an adjunct to that, James, I suppose that even given the disruption of a sort of tier one bank suddenly saying, oh, by the way, we're offboarding you guys, it might be an idea for people to have a prime of prime FXPB or PB as well as a tier one PB, just as a backup almost, because of the potential systemic disruption of some kind of an event which causes that particular bank to decide, as many of the banks have over the last few years, for one reason or another, to shut down their FXPB operations. What do you think about that?
It's funny you mention that, Larry, because that's the conversation that we're having time and time again at the moment.
Oh, really?
We ourselves, because we provide access to a number of different asset classes, predominantly FX and metals, as I mentioned, but also equities, equity derivatives, futures and futures derivatives as well, on an OTC basis. We would always take the approach within our own business that we'll have multiple prime brokers that sit on our panel for each of those asset classes. So we're never reliant on a single PB for any of the asset classes that we bring to market and look to offer to our customer base. So the concept of having a tier one PB sit alongside a prime of prime is actually a really interesting one. And it's one that can, if done well, work beautifully, because if you think about one of the benefits that tier one PBs bring, it's really that ability to move positions and to manage risk between those facilities. Generally done via give-ups, whether they're three-way or four-way give-ups. One of the challenges that customers, whether they be hedge funds or brokers, have when dealing with the prime of prime is that often there isn't that transportability, if you will, of positions. Now, this is the case with many prime of primes, but certainly not all. One of the things that we actually do very well is we work with customers and their existing panel of clearing venues, whether they be tier one or tier two prime brokers, bank or non-bank, and really ensure that the network that we create for that customer, the ecosystem that we put together, facilitates the movement of those positions. So we will accommodate give-ups, to a client's other PB network participants if that's what the client chooses. Put simply, it's plain friendly to the benefit of the client to make sure they're getting that real efficiency for their capital, and they can effectively manage their risk, given the various clearing venues that they want to be utilising. So yes, I think it's a really interesting time for people to be looking at prime of primes as a genuine, whether you consider them a backup or whether you consider them an adjunct or a complement to the existing tier one relationships. I think that strategy is one that we're going to see play out a lot more, given the need for backups and, look, very honestly, the uncertainty with which the appetite amongst certain PBs to continue providing clearing services seems to be prevailing.
Excellent. And James, given these changes, how do you see the future of FXPB and of prime brokerage in general?
Yeah, it's one that we see really, I guess, leaning towards those entities, or favouring, I should say, those entities that are less constrained, that find themselves less hampered by some of the regulatory requirements, particularly the more onerous balance sheet requirements that come off the back of regulations like Basel II and Basel III. I think for entities that are able to provide the services and the access to markets and the credit, or the NOP, in a flexible way, those entities I think are really going to thrive. And I think it's these changes that we're going to continue to see playing out in the coming months and years, because it's, I guess, our strategic view that, you know, this regulatory environment will always move slowly, but we do think that it is here to stay. We don't think that, you know, many of the key regulations, such as Basel II and Basel III, are going to be watered down or repealed in any material way in the foreseeable future. So the regulatory environment that we find ourselves in, we believe, is here to stay. And I think that speaks volumes for the opportunity for, you know, entities that are less impacted or able to better leverage the assets that they have, be that balance sheet, you know, technology, access to markets in that environment. I think an increased focus on technology-based solutions, particularly around credit and risk management, are going to continue to become key. And I think that, you know, if I come back to that example of the Archegos fallout and the questions that are now being asked by PBs across the street about what other credit allocations have been made, I really do think that this is an area where technology can step in and play a very valuable role that ultimately will benefit the whole industry and will actually move the industry forward collectively, because there's always been that challenge of trust and communication between the PBs and the various clearing venues as to what allocations have been made to clients. And I think that this is where technology has a real role to play, and I think we're going to see that playing out in the coming, you know, months and years. The final thing I think I'd actually mention there is diversification across asset classes, because again, just coming back to our strategic view, we think that one of the best ways to manage and mitigate risk within customers is to ensure diversification across portfolios. Now, obviously a simple thing to say, everyone talks about diversification, but diversification across asset classes for us is key. And I think that's one thing that we really focus on, we try and do really well, is make sure that we're offering a broad range of asset classes and trying to encourage the customers who enjoy and who need those, you know, diversified asset classes as well. I think that those PBs who have traditionally been focused solely on a particular asset class, whether that be FX or any other asset class, I think those business models are going to struggle for two reasons. I think the risk profile of the customers is generally going to be considered to be higher. And also, I think increasingly customers are demanding a multi-asset solution with collateral efficiency. And if the PB or indeed the prime of prime is able to deliver that multi-asset solution in a capital effective way, I think that's a really strong point and a key focus for where we believe the industry is going to move to.
Excellent, thank you for that comprehensive answer, James. Given your geopolitical situation, you're down in Sydney. A lot of the PBs are in North America and Europe, and in many other ways. How does this impact you at Invast Global, and how would that impact your risk profile in terms of potential clients?
It's a very good question, Larry. The first impact is a lack of sleep, I would say, to be perfectly honest, mate. Look, right. This is one of the benefits and the challenges that comes with having our headquarters in Sydney. Obviously, our parent company, our listed parent company, is based in Tokyo as well. We have actually recently established operations in Europe for the first time, so operational support for our dealing and risk functions. So that expansion is already taking place. But look, being based here in Asia actually presents quite a lot of opportunities as well. We are in a very fortunate time zone to be able to straddle both the US and UK markets, particularly those crucial market on open periods and market close in New York. I think the other thing that is widely understood of the Australian environment in particular is the particularly strong regulatory and banking structures that we have down here, which really, I guess, add a lot of comfort for, in particular hedge funds, brokers who are, ultimately posting significant amounts of collateral with their prime broker, knowing that they're dealing with, tier one banks and a strong regulatory environment. I think those elements play very well with our customer base. And to be perfectly honest, I mean, many of the relationships that we have, both with liquidity providers, with our prime brokers, ultimately are well serviced out of places like Hong Kong and Singapore. Where we find, I think, the greatest slowdown is on that risk and credit side. Again, coming back to the onboarding challenges with number of PBs at the moment. We hear from our customers that often when you are based in Asia, that those key risk and credit decisions will ultimately be referred on to Europe and the US. So, we do lose days here and there amongst our customer base, but I think our business is very much optimized for that 24-hour operation, and certainly having the operational and risk support in Europe is helping that.
Well, it sounds like an exciting portfolio and potential for clients. Only remains for me to thank you on behalf of eForex, EFX.World, and SJB Media for coming on our podcast today. Thank you very much, James.
Larry, it's been a pleasure. Thank you so much for having me.
My pleasure.